All right, it is time now for Mike on the Money. I am joined by Money Mike Giordano, financial advisor with Williams Wealth Management. You were in California last week, but it's good to see you back in studio this week.
I tried to bring good weather for you, but obviously I failed, so I brought a cheery tie at least.
Well, got it. I appreciate that. Thank you very much. We're going to talk about investing. We know that investing can feel complicated and even overwhelming at times. So what is the first misconception that we should keep in mind about investing?
Yeah, I mean, oftentimes people think that investing is kind of like clockwork. Whatever the expected return is, what you're going to get. So if a client comes and says, hey, I want you to build me a portfolio that can generate 7 or 8% rates of return, they might think that you're going to get that 7 or 8% year after year after year like clockwork. And that's just not how it works. It basically is lumpy. It's a roller coaster. So if you take a look at the S&P 500, over the long term, it generates about a 10% rate of return over each year. But only about once out of each decade, you get anything close to that 10%. Usually you're either way higher or you're much lower.
And there's a slogan that we've heard from you several times before, just in the past: set it and forget it. So for those hearing that for the first time, break that down.
Yeah, so the key here is that you don't want to set it and forget it. And so what we find out is that oftentimes people think they can invest the same way throughout their entire lives. So I've seen investors over 20 and 30 years, you know, they may have been very aggressive growth investors and they just kept pounding money into it. It worked. They built up a big pile. Now all of a sudden they're about to retire, and maybe they went through something like 2022 where the markets had a bunch of turmoil, and they're like, oh my gosh, like this is not exactly the experience I was looking for, because I'm down several $100,000. Maybe I can't retire. So the key is that the further you are from a goal, when you're just getting started out, volatility is your friend. But the closer you get to that goal, now all of a sudden volatility is not your friend anymore, and you have to start dialing in those risk parameters. So you have to adjust how you invest when you get much closer to a goal.
And with that, going back to the word misconception, right, how does that relate to the past versus the present when we're talking about investing?
Yeah, I mean, you've seen the disclosure several times that past performance is no guarantee of future results, right? We all hear it, and I can tell you almost nobody actually takes it to heart. They all think like, oh, this is what that investment did in the past. This is what it's going to do again here in the future. And so they oftentimes have a problem where they see that something was really hot over the last 6 months, year, 2 years, 3 years, and they say, I'm going to plow a bunch of money into that because that's what's worked in the most recent past. The problem with that is that market conditions could have changed. I mean, the situation, the setup might be completely different than it was 2 or 3 years ago. So the better way to handle it is to take a look at the long history, take a look at stuff, how it's performed through market cycles and maybe decades, and that will give you a better gauge of how to channel your investments.
And when you're using that lens to look at it all, you don't need fancy or sophisticated investments to do all this, right?
Yeah, there's a misconception that the fancier something is, the better it is. We all love to be part of the club. We all love exclusivity and to feel special, and that's all wonderful. But at the end of the day, you have to ask yourself, do I want that story at the cocktail party that I'm invested in this really exclusive thing, or do I want to make money? And the thing that's better for your family, for yourself, is generally if your investments make money. And so oftentimes the boring stuff can be really powerful. The key here is that exclusivity can be fine, or special investments can be fine for a portion of your portfolio, but you want the bulk of it operating in a function where you're buying high probability investments that are going to make you money.
All right, Mike G, keeping our pockets full. Mike, we appreciate it.